Hello, welcome back to Core Finance. I'm Matt Brown. I'm joined by David Paul, the MD of VectorVest. Good morning to you, David.
Morning, Matt.
Worry-free investing. Talk me through that.
Okay, well, at VectorVest we sort and rank all of the shares in the London market and on all the world markets by value, safety of earnings and trend. And in worry-free investing we focus mostly on safety of earnings and on the VectorVest measurement called relative safety. When the general market is rising, then we want to be fully invested in those shares that have got the highest relative safety on the UK market. The first step is to work out whether the market is rising or falling. Everything follows from that. And in the first slide I'll show you exactly how we go about doing that. This is our market timing model. It's the most conservative market timing model on VectorVest, and the red and the green triangles on the chart refer to what we call confirmed calls. And over the last year we had a confirmed call, you can just about see it about this time last year, which ran right through to the 4th of July. And as we go into the trading day today, the longer term trend, which is reflected by the red and the green triangles, is down, but the short term trend is up. Now, if you were a short term swing trader, then VectorVest certainly gives you permission to be buying shares today. But based on the worry-free methodology, we would still be, in fact, sitting our hands and waiting. Okay, rather than using and sorting shares by the VectorVest master indicator, which is a mixture of value, safety and trend, in worry-free investing, as I said earlier, we just focus on relative safety itself. And on the next slide I've actually defined how relative safety is made up. Earnings consistency, the size of the company itself, a little bit of price volatility. We want focus on shares that are rising smoothly as opposed to all over the show.
Understood.
How long the share's been around, and dividends. And if a share pays a dividend, even a small dividend, and it has a history of growing that dividend safely, then that marks very well on the relative safety indicator. And then, of course, we look at all the financial ratios, of which the one I look at personally most is the old debt to equity ratio. Okay.
A very important ratio, indeed.
So VectorVest then rates every share in the London market on a scale between 0 and 2 on relative safety. Above 1 is fair, above 1.3 this is a company that's making money, and all those ghastly financial ratios are getting better. I started life as a mechanical engineer, so they're all getting better.
Good.
This is the process. So we get a confirmed call, which is one of those little green triangles on the chart. Once you've got one of those, which we haven't got at the moment, once we've got one of those, then we actually sort the UK market by relative safety, and that brings all the shares on the market with the highest relative safety to the top of the list. And we simply buy 10 of those, diversifying ourselves across the market with no more than 2 shares from any one sector. We use VectorVest calculates a stop loss every single day. Now, as long as if the general market is going up, there's a very small probability that it will be stopped out of any of those shares. But if it does happen, we run the sort again and we replace. So when the general market is rising, we're always fully invested. You're going to find it very difficult to beat if you're not fully invested when the market is rising. Now, sooner or later, we're going to get one of those little red triangles, as sure as night, day follows night. And when you get a red triangle, then the market is moving down. We're much more likely to get stopped out. If we do get stopped out, in a down market, we don't replace and we build a cash position. So if we've got a lengthy sell-off, which we haven't had for a long time, but if we've got a lengthy sell-off and you get stopped out of 2 positions, you'd now be 80% in equities and 20% in cash. When the next confirmed up signal occurs, then we run the sort again and we replace. So basically we replace stopped out shares when the market is rising, and when the market is falling, we don't replace. Okay.
Good stuff. And what are the objectives?
Well, the objectives, one is capital appreciation. The second objective is dividends. And then, of course, if you've got some knowledge of options, you could actually write covered calls. Quite difficult to do in the UK retail environment. If the general market is rising, you could certainly write put options if you've got the ability to do that and the confidence to do that. But quite difficult at the retail level in the UK. In the US, then, grannies are writing covered calls. It's the most conservative option strategy there is. So, but not that well known here. So, in the UK, capital appreciation and dividends.
Good stuff. Moving on, well, let's have a look at worry-free investing in the US and the track record.
Well, yes, I've tested it for 20 years in the US, from May 1996 to June 2016. So 20 years through all sorts of markets. Right up into 2000, the sell-off to 2003, the run-up to 2007, and then the crisis and the bull market ever since. So lots of market types there. In 20 years, we placed 177 trades, and at the end of that...
which isn't many. I mean, some may think that's
one every 6 weeks.
That's fantastic.
Yeah, one every 6 weeks. The objective is to keep this under control in 15 minutes a week. Okay. At the end of the 20-year period, there were still 10 open and 167 had been closed. We collected 544 dividend checks along the way, which was $51,000 on a $100,000 portfolio of dividend income. And in the next slide, in terms of the results, I actually haven't added the dividends at all. So just assume that you spent the dividends on best bet or something. Yes. And that's what it's done over the 20 years.
So this is just the pure capital appreciation.
Pure capital appreciation, yes, and it would have done significantly better if we had added in the dividends along the way. I'm sure you've seen those sums over the years. So it went sideways between 2000 and 2003, so it outperformed the market in that period significantly. There's a little bit of drawdown in 2007, but it certainly outperformed the S&P significantly, and since March the 9th, 2009, then it's outperformed the market. Over the last 20 years, that's produced a 17% compound growth, whereas the S&P 500 is up 9%. So it's outperformed the market very nicely, and we've done that in the safest shares in the US, and it's been done in 15 minutes a week. On VectorVest, we've got a thing called the Genius, and when you plug this into the Genius, it actually sends you a little email when there's something to be done, and you get those every evening as the data's uploaded about 7:45 or so in the evening. So you've got a list to actually guide your thinking the next morning, and it's all done on smartphone these days. You don't even have to plug your computer in.
And as you say, it's aimed at being kind of 10-15 minutes per week. You're doing the hard work, you're doing the maths in the background. So as an investor, you're just buying the product, and it will tell you what to do and when to do it. And it's very, as you say, worry-free investing. Yes,
in the safest UK shares, and in this case, the safest American shares with very little risk to your capital. That's the UK. Now, I've done the UK test since 2009. The UK has actually done better in that period, and that's a £50,000 portfolio, which was appreciated to £236,000 since 2009. So, and again, that's running at about 18 or 19% capital growth. Again, no dividends have been added into that. It's our most conservative plan. And when I was on here, I think a week ago, I talked about a swing trading methodology, which I think will outperform this, but nevertheless it takes a great deal more time, and it takes a great deal more, maybe a little bit more subjective input, whereas this is completely and utterly mechanical. And it's a wonderful, and we could call it the ultimate retirement solution.
Good stuff. And if our viewers want to find out more about, well, hopefully worry-free investing, that sounds like a fantastic concept, and obviously you showed the performance. But anything else about VectorVest? Where can they go?
Well, VectorVest.co.uk is the best place to go. And anybody who wishes to take a 5-week trial of VectorVest, it's £5.95, and that includes access to the UK market and to the US market. And we have a back tester on VectorVest, and you can actually rework all my calculations on that back tester very easily in the 5 weeks. We'll have seminars again in central London. We're having one, I think, in the middle of January the 20th at a central London hotel. And if you keep your eye on the website, you shall be able to enroll for that. It's a free seminar. Okay.
Fantastic. Well, in the meantime, that's you done for this year. We'll certainly have you back in the new year to discuss. But in the meantime, David Paul, MD of VectorVest, have a fantastic Christmas and New Year, and we'll see you next year.
You too, Matt. Cheers. Thank you.